The following podcast was recorded on Tuesday, August 17th, 2021, featuring Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to our latest edition of Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Today, Jim and Ben are going to give us an update on the supply chain, Delta variant, and commodities. Ben, we're going to get started with you today on the supply chain update. Getting goods from China, getting goods out of China to Europe and to the U.S. continues to be very expensive, and the backlog is getting worse. What's the latest on the port congestion?
Yeah, about 7 days ago, I think everyone started to get pretty nervous and started to scratching their head like, oh no, we have another Yantian port closure upon us. And we do to a certain extent. Ningbo shut down. They had a case or cases, who knows how many in total, and they've been closed again for about 7 days. That's caused a hefty number of ships to be stuck out at sea. I think there's 50 plus that are out there. This is from marine traffic showing the amount of anchored ships off of Ningbo, which is to the south there. And there's some good news, though, that's all of a sudden coming across, and they're going to supposedly begin to open up that port, the Mishan portion of the Ningbo port, going forward, maybe starting tomorrow, which should hopefully keep a lid on these container rate prices, which looked like they were stabilizing. If you remember back in May when the Yantian port closed, that's when we saw an incredible rise from 4,000 or 5,000 per 40-foot box to as high as 12,000, 13,000 from Shanghai to LA and to Europe and so on. But so the supply chain, I think, won't be as impaired as during the Yantian experience. If you go to the next chart, we do try to track on a global as well as the US level how much are consumers and businesses interested and concerned about the supply chain. Fortunately, those searches from everything from building materials all the way down to bottlenecks and shortages have somewhat abated. And this kind of feeds into the theory or idea that prices paid, delivery times, and so on, all the supply chain mess likely peaked somewhere between May and July of this year. So in the next chart, what we've done is we've taken a lot of the really big high-flying components that are measuring these supply chain issues, everything from year-over-year changes in spot prices of commodities, flatbed rates, the used car prices from Manheim, small business surveys for prices, and so on. And all of those did end up peaking at somewhere around 2.5 standard deviations above average, looking back to the 1950s. Now that is at the highest level of all time. So we do have this whole level versus rate of change debate, and that's what's going to matter here going forward, is how quickly does this prices paid, delivery times, and so on come back to their long-term average. Historically, when this has happened, we've seen a peak in these values. It's taken about 10 months to do so, and that puts us somewhere around April of next year. So the story will be with us for a while, but I think with the supply chain, there are hiccups. There'll be continued hiccups. Fortunately, it looks like the Ningbo experience with the port closure is not going to be as significant. I believe they're still able to do somewhere around 77,000 TEUs per day, which is only maybe about 10% below average, the July average. So it's not like goods are totally stuck this time around. So I'm still kind of working under the theory that May, July is when we saw the peak in supply chain woes.
Yeah, and I think if you would expand it out a little bit more and not to crouch into the next subject, you're starting to see supply chain wars or disruptions through the rest of Asia as well too. Japan has had a big COVID problem, and Toyota has been idling a lot of their factories depending on the rate of COVID cases in those particular areas as well. South Korea, Indonesia, Malaysia, they have all had similar types of issues too, and even Taiwan. Although Taiwan has not really idled much of anything, they're also considering it, or they're on the wavelength as well too. So remember, a lot of this disruption is COVID related. That as they get COVID cases, they then see these shutdowns. And unfortunately, a lot of them have been coming in the port cities and in the port facilities themselves, which has been causing these disruptions in the supply chain. Here we are now, 18, 20 months after COVID began, and we're still not ready yet to totally get the supply chain back to normal. Now it will soon, but we're still not there yet.
And Jen, can you let us know what's the latest with the Delta variant as schools begin to reopen and companies attempt to have workers return to the office? What else is happening? What's your forecast?
Yeah, so if you start looking at what's been happening in the United States on the Delta chart, what you'll see is that that orange line is the rolling 7-day average. Now, July 5th, that was 12,000 cases a day on a rolling 7-day average. Today, it's 134,000 cases a day. And all the spikes you've seen recently on the chart is a lot of states have gone to weekly reporting. And so they report weekly on Friday. Most likely, if this pattern holds, we'll be up around 350,000 cases on Friday, and we should set at least nominally a new daily record, and we'll probably see the orange line move higher. So the case counts continue to rise. Now, the typical Delta variant has run somewhere between about 4 and 8 weeks. When you get a rise like this, we're in week 5. So if we are typical, we got about another 3-ish weeks to go before we see a peak in this. But unfortunately, the reality is you've got the case counts, and the case counts are driving policy. So whether you get some kind of mask restrictions or vaccine proof or vaccine mandates or whatever else you want to get, the catalyst for this has been cases. You could say, well, what about death rates and hospitalization and treatments and vaccination percentages? Because the vaccinated supposedly get a much milder case than the unvaccinated. All of that is true, but the policy is set up one number. In fact, you could see that in a lot of the report, in a lot of the decisions they make when they decide to institute mask bans or vaccine mandates. They will tell you because case counts are rising. Well, people are getting sick, but it's like the flu. But case counts is what drives everything when it comes to policy. If we move on to the next chart, just drawing it a little bit bigger, what happens after we peak? Well, there's the UK. The UK peaked around late July at around on the orange line, around 48,000 cases a day. And then they fell to 25,000 cases a day. And then they kind of stopped, and they're creeping a little bit higher. So they had a 50% drop, and then they've kind of stabilized. Normally, you'd want to see that thing start heading its way back to where it was pre-Delta, somewhere under 5,000 cases, but we're not doing this right now. So if this is any indication of what we can expect, and I know it's a sample of 1, so keep that in mind, when we peak, it may not be a rapid drop-off as well, too. Good news is the next chart. If we take a look at the next chart, Ben walked us through the port problems in China. This is Asia less China cases. Remember, this is being driving with all the shutdowns. It looks like it might peak. Peaked. The orange line peaked about 2 weeks ago. They're down to 53,000 cases in the region in total. That is down from around 80,000 plus just a couple of weeks ago. Everything seems to be trending south. Now, we'll see how far they go down before they stabilize like the UK, but at least they peaked, and this could spur in the next week or two reopenings through the rest of Asia. And the final chart I'll throw us out at is the worldwide infection rate. The worldwide infection rate is still trending higher. Interestingly, this is without India. Delta is really not doing much at all in India, even though they've got a very, very low vaccination rate. I don't know if that's a reporting problem or if the virus is really not there. But we're still running around 600,000 cases worldwide, and it's going to be a while before we see these numbers start to trend lower as well, too.
So Ben, for our final topic today, let's move over to commodities. Are commodities the best inflation hedge?
Well, history says yes, and so we'll see if that's the case. I don't know if that will be the case over the next 6 to 12 months, but we did a quick study. If you look at all instances when CPI ran from headline CPI ran from 2% up to 5%, what during these inflation regimes historically back in the 1950s, which assets perform best on a real basis. So we look at the returns and we strip out headline CPI. And there's no doubt that it's commodities, even things like gold, industrial metals on average produce somewhere around 19%, iron and steel, somewhere around 10%, and so on. So history says that during these bursts, and also especially during global economic recoveries, commodities are going to handedly beat out the S&P 500, the 10-year note, and other financial assets. Now, the circumstances here are a little bit different with the heavy amount of stimulus that we've seen on the fiscal and monetary side. So we do have to take that into consideration. Additionally, we're going to be coming off of this significant potentially peak in supply chain issues, and like we just showed with prices paid and delivery times and so on, that should start to curtail some of the hefty demand we see for some of these commodities. Now, again, it depends on how much of the goods we ship from goods to services and how fast that happens. But I wouldn't be surprised to see somewhat dampening demand. We've already seen that. If you look in the US, for example, the amount of goods that have to move across the country via flatbed trucks, that demand measured by internet truckstop.com has kind of cratered in the past number of weeks. And so there's the chart there showing that demand's come down, and that's also allowed the cost of moving stuff to drop finally below $3 per mile, which is a good milestone to fall back below, and we got plenty of room to go. But I think what is going to happen is, and this is something that harkens back to what Jim and I's former colleague, is that commodities as an asset class, I don't think it's going to be able to be so viewed so easily this time around, especially over the next 6 to 12 months. As we get all these idiosyncratic movements, demand here, supply issues there, I think we're going to get commodities trading more like they should, which is disparate, different types of beasts. Be it the grains attaching more to the grain markets, be it weather, the growing conditions, and so on. Industrial metals attached to how much Chinese demand there are, how much goods and stuff we're producing. And so I get the feeling that investors should be prepared for a disjointed situation and not have it be as clean as history. So it's nice to say I can go out and buy a DBC or some kind of commodity fund or ETF, and that's going to be a great inflation hedge. I just don't think it's going to work out so nicely this time around. I wouldn't be surprised to see some positive returns here, negative returns there, and it's going to be up to the investor getting pretty savvy with being able to pick out which commodities are going to survive this goods to services shift and really the peaking in supply chain woes and what happens to consumer demand as stimulus wears off and so on.
Yeah, Ben, let's call it what it is. That former colleague is Howard Simons, and I know he worked with us for a long time, and he famously said to both of us, corn, copper, cocoa, coffee, crude oil, they all start with the letter C, but they all don't belong in an index together called commodities. And he was 100% correct. They all move to different cycles. They all have different fundamentals at different points in time. And everything else. So if you're going to call commodities a hedge fund, you're saying there's no difference between corn, crude oil, and coffee, that they're all going to move up together or they're all going to move down together, and they don't. I threw out one chart, one thing that Ben talked about, and that's industrial commodities. The raw industrial spot, which is the orange line, is moving higher. It had somewhat of a relationship with interest rates over the last 10 years or so, and it's diverged. And it is probably the commodity that is most sensitive to what we talked about in the first section: port shutdowns driven by COVID and the worldwide global supply chain. That's up. Now you could go into some of the foodstuffs and some of the precious metals, which I didn't show charts of. They're trending a little bit lower as well too. Lumber prices, which everybody was talking about a few months ago, are collapsing on themselves. So commodities go all over the place. Are they going to be a good hedge? Some of them, for some reasons, can be a good hedge, but I completely agree with Ben. If the idea is inflation is here and you're going to run out and buy the DVC commodity index because you think inflation is here, that's not a smart move, because parts of that will go up because of inflation and other parts of that might not, or parts of that might move higher, irrespective of inflation. Maybe the drought that we're seeing, Colorado River's got a real problem. If that drought consists, you might see agricultural prices move up, but that's not about inflation. That's just about weather patterns, is what that is. So the bottom line is, no, I don't think it is necessarily a good move, a good indicator or a hedge for inflation right now. But, you know, unless you want to narrow it down to like something like buying copper or buying industrial commodities in the larger.
Well, thank you both for your thoughts today. We really appreciate it. Thank you for everyone for joining us today. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For further questions or any other information, please contact Gus Handler at gus.handler@arborresearch.com.